Welcome to the Edge podcast, where we cut through the noise to focus on what actually moves the market. This week, we're unpacking some big development shaping the Nigerian financial landscape and the global economy. We'll break down Nigeria's proposed 2026 spending bill. The government is proposing a 55 trillion budget expenditure for 2026 with a hefty 20 trillion deficit and a debt financing that is expected to eat up nearly 16 trillion. And we'll talk about what it signals for fiscal sustainability, interest rates, and investor confidence. On the equity side, we'll be spotlighting Fidelity Bank. We'll be digging into earnings quality. We'll be talking about valuation and whether recent price action still supports an investment case for Fidelity Bank. And finally, we'll zoom out into the global economy. We'll be discussing latest FOMC decision, the rare dissenting views, I must tell you, the US labor market, and what all of this mean for growth expectation and capital flows to emerging markets like Nigeria. Stay with us, everyone. This is the Edge podcast. So joining me today to dissect all of this is my friend Andrew Esene. Andrew Esene is an assistant vice president at FSCL Securities. Andrew, welcome to the Edge.
Thank you, Doctor. Great to be here again.
All right, welcome. How's the week been so far for you?
The week has been good. We had a positive close to the equities market last week, up 1.63%. So it was a good week for investors.
So investors are smiling.
Yeah.
Okay, right. We'll talk more about equities shortly. Let's talk now about the proposed 2026 spending bill. So earlier in the week, we got that report. The federal government is released the 2026 to 2028 medium-term expenditure framework that projects a total spending envelope of around 55 trillion for 2026. Revenue is expected at about 34 trillion and deficit of about 20 trillion. If I check correctly, that's about 3.6% of our GDP. The government is also benchmarking crude oil prices at about $64.85 per barrel. Exchange rate is projected to be about 1,512. In my view, I believe this is a conservative estimate that reflects prudence amid the volatility that we've seen in the last couple of years. So, Andrew, how do you see these assumptions, given that we are talking about budget assumptions that rarely match or keep up with the expectations? So how do you see these key assumptions, the overall fiscal framework compared to what we had in 2025 budget?
Okay, thank you. The assumptions appear more realistic compared to previous years, where there's a significant divergence between what the production volumes, the actual production volumes against the projected average oil price levels, and then a wide deficit. Though the wide deficit remained, but the projections in terms of oil production and the price level, the oil price level at around $65 per barrel, and then production levels at 2 million barrels per day. Production is more realistic than what we've seen in previous budgets. So the exchange rate at around 1,500. We are currently at around 1,460. So largely the parameters that are being used for the medium-term expenditure framework, especially for 2026 budget, appear more realistic than what we've seen in the past.
Okay, so they appear more realistic. So we have a more realistic assumption compared to what we have in 2025 budget. Now, I don't know if you've been tracking the implementation of the 2025 budget and where we stand today. But what is very obvious is that we are going to have about 16 trillion naira in debt servicing costs. What do you make of this, especially looking at fiscal sustainability? Because this is significant if you look at how much this is going to go from the 2026 budget.
Mm. Well, yeah, the concerns are around fiscal sustainability and mainly on the debt side. And so the challenge would be that if we have shortfall in revenue, then it's likely going to affect capex spending for the period. So although we have the tax reforms coming, so the government is expecting to generate more revenue from taxes. But the wide deficit of about 20 trillion naira, we know that the government will seek to source that from the local and international markets. So it's just we're coming up from 16 trillion naira deficit levels to around 20 trillion. So it's really that deficit will be sought from the market. There is a tendency that it will crowd out the private sector, like what we've seen in recent times, where the rates at the treasury bill market, the long end of the treasury bill market, have continued to edge upwards because the government is taking in those funds. So investors are pitching at high rates. So we may go into 2026, though the expectation was that there will be a drop in the monetary policy rate, and then borrowing costs will be cheaper. But given the depth of the deficit that the government is looking to take early in 2026, we may see these high rates, persistent high rates going into 2026 because of the government's borrowing plans.
Yeah, that's true because only I think at the beginning or close of last month, the DMO actually revised the bond and treasury bill issuance calendar, and that really jacked up the amount they wanted to raise for the end of the year. And that's not also considering what the amount of deficit that needs to be financed going into 2026. So I agree with you that will continue to see persistent high interest rate. If you ask me, that would be good for investors who are looking to put their money in the fixed income market. But let's talk about the larger risk that this may pose in case, in terms of the revenue projections for the government. So the government is largely expecting increased crude oil production, and obviously we've seen their projection for crude oil price. Are there any type of potential risks that might see in case there are, oil crude oil prices drop and non-oil underperformance? If that were to happen, how would this impact the implementation rates for the 2026 budget?
Yeah, there is the risk of lower crude oil prices. If we see a resolution to the Russia-Ukraine war, then
yes,
and then with the Chinese economy slowing down, then we could see lower crude oil prices. The volumes are really, in terms of production volumes, they are really within our control, and so hitting the target of about 2 million barrels per day is a realistic target for us. But the risk is really with international crude oil prices. And like I said, the capex expenditure for the government, and then we'll see a very low implementation rate for the budget if those are not met. So the risk is in capital expenditure and also the rates of implementation of the budget if we see those revenue shortfalls.
Okay. So For an investor watching the market and looking at this 2026 budget proposal, how do you think the proposal would influence investor sentiment, especially regarding the amount of deficits, the economic diversification, and the potential impact on inflation and naira stability? So we have governments going all out to spend, and then we still have the issue of the exchange rate. The naira is still weak, and we'll have a persistent inflation as well. So how do you read this as an investor?
Well, typically investors follow the money, and the government is a major spender in the economy. So for particular sectors that will attract this expenditure, investors will be looking at those sectors, because government spending will multiply. There's a multiplier effect, in those particular sectors. So investors will be looking to go with the government, so to say, into those sectors. However, if we do not see an increase in production in those particular sectors to match, or in the economy generally, to match the increased spending of the government, then that would put some inflationary pressures on the naira, and we might see inflation maybe ticking upwards. The projection for general analyst projection for inflation is that would average around 20% for 2026, and so that is likely going to be that we see inflation numbers tick upwards from the current levels, from what we're expecting, a 15% reading for mid 15% reading for the month
For November?
of November and December. So
Okay.
if this the government expenditure, the inflationary pressures will come back to to affect consumer spending and the disposable income.
Oh, so do you think that this is one of the reasons why the MPC declined to cut rates initially? They expect that inflation will continue to go up. Do you think this is one of the reasons why they didn't cut rates in the November meeting? Hello?
Yes. So the part of the reason was because of the festive spending that was expected in the month of December and going into January, the festive period. So that would cause some uptick in the inflation numbers that we're expecting. So that's part of the reason why we believe the MPC decided to hold rates and just do a technical cut on the asymmetric corridor side. Yeah.
Okay. All right. So Andrew, let's switch gears a bit, and on the equity side today, we are spotlighting Fidelity Bank. So Fidelity Bank's gross earnings have jumped to about 44% year on year to over 1 trillion naira. But the profit before tax is actually slightly down by about to just about 5%. And so one will begin to wonder why, with the amount of earnings that the company had, why are they having this amount of why is it not trickling down? So if you have profits before tax just around about 5%, why do we have that softer value? Is it due to the cost, maybe funding cost by the company, or what's really the challenge with the company's earnings potential?
Well, we did see a drop in their interest income for the period, and also the windfall tax also impacted their profit levels, and that brought the dip of 5% that we saw in the and in the bottom line. So we're also comparing this period to the corresponding period of 2024, where we had increased FX returns, FX income for the banking sector. So year on year, most of the banks actually reported lower bottom line on a year on year basis. So that's typically what affected Fidelity Bank as well.
Okay, so with Fidelity Banks, so you mentioned their net interest income. I think that's holding steady at about 145 billion for Q3 of 2025, and a rise in fee income, about 47% of that. So what factors like their retail lending expansion and digital banking initiatives could influence future profitability for the company, especially given the high interest rate environment and inflation trends?
Yeah, you mentioned it. The way to go really is the retail lending expansion and digital initiatives really. And Fidelity Bank is actually known. It has earned popularity as an SME bank, But I think a foray into the retail lending space will help to also improve the interest income margins, for retail lenders. We've seen fintech players play highly in that space, and the margins that they get from there, although with the increased risk of higher NPL levels, non-performing loan ratios, but the higher margins in that field is quite attractive. And the thing to do really is to put in place the proper risk framework, to manage the risk of lending in that space. But the higher margins that's really the way to go. We've seen the fintechs pivot into that space. And so with a mid-sized bank approaching tier one status like Fidelity Bank, they have the leverage to also play in that space and put in place the necessary risk framework to manage the risk in that space. But the margins are quite high, and it's really where we expect most of the banks to pivot into.
Oh, all right. So the Fidelity Bank's total assets grew to about 10 trillion and customer deposit to roughly about 6.9 trillion. Their NPL still very low, maybe about 2 to 3%, and they have a capital adequacy ratio that is above 16%. So from an investor's point of view, does this balance sheet expansion look like disciplined growth, or is there a point where the pace of scaling starts to worry you in terms of assets quality and capital?
Well, the growth looks healthy with NPL ratios at 2 to 3%. Capital adequacy ratio at 16% is healthy, although there could be there's room for growth in the CAR level because it's just sitting at the regulatory benchmark. So there's it's expanding at a healthy pace, but there's still need for an increased buffer on the CAR side to give greater comfort to investors.
All right. So given where the bank's current valuation metric stands, they have a P ratio, you could say decent, about 3.9. Their price to book ratio about 0.9, alongside a resilient year-to-date performance and strong interest growth. Would you be advising our viewers to buy, hold, or sell the bank, especially heading into 2026? What would be your advice?
Well, the valuations are attractive, but puts alongside other industry players, the average PE ratio for the banking sector is around 2.8 times, and Fidelity is trading at 3.9. There is also that says that the stock is a bit pricey compared to other players in the sector. There's the positive of a lower minimal risk of FX volatility. So we don't expect volatility in the FX space, although that would even it generally benefits the banks because of their positions in the FX, even though that has been cut significantly by the central bank. Also, the bank is yet to finalize its recapitalization efforts to meet the new minimum capital requirements. So though the valuations look attractive, there are some edges that need to be properly smoothed out. The PE levels are higher than what others are trading at, and then we need to see a finality to its recapitalization efforts to know that yes, they've successfully crossed that hurdle, and then they are well positioned for growth.
Yeah, any ideas what the bank is doing to meet up that capitalization requirement? Are they coming to the market, or is it a private placement, or what are they doing?
Yeah, so it's a private placement after they came to the market and raised significant. The offer was quite successful, but to
Okay.
meet the minimum requirement, they're still in the private placement space.
Oh, okay. All right. Thank you, Andrew. So let's zoom out now to the global economy. Last week or thereabout, last week we were tracking the FOMC rate decision, and the market had priced in the possibility of a 25 basis point cut. But what really kept watchers of the FOMC meeting surprises the splits, or would I say the three dissenting views, if you like. So you had about 9-3 members of the committee voting to cut the rate by about 25 basis points. So you had another member of the committee that wanted a higher cut, maybe about 50 basis points, and then two others kind of abstained. So you have three different views. But obviously, the majority had the rate cut to about 25, cut by about 25 basis points. And now we have rates sitting around 3.5 to about 3.75. So this making the first time in maybe about 6 years, truly, where you are having these type of dissents in the FOMC decision. So what does this internal, would I call it internal division, and what does it reveal to you about the Fed's balancing act between persistent inflation risk and the softening of the unemployment data?
Okay. If we look at it as a whole, we had 10 members of the FOMC moving for a cut in rates, and just two deciding to hold the rates at current levels. So that really speaks around the concern around unemployment position. Though we are seeing persistent inflation, but the inflation target is we've hit the inflation target, though there are still pressures on that space. But the focus has moved, or is moving, towards economic growth, and then solving the unemployment problem that is still rearing its head. We had a significant number of job cuts and increased benefit claims, and so
Yes.
the cut in rate is supposed to help prop increased economic activities, production, and employment. So the focus is looking towards that space, given that the inflationary pressures have been largely tamed. So 10 members voting for a cut, and then two deciding to hold rates at current levels just shows the focus. Like you mentioned, the balancing act between employment and the inflationary pressures. That's where the division really is, and most of them decided to go for solving the current unemployment challenge.
Yeah, so how concerning is this labor market slowdown, especially in sectors like government and tech, because that's where we're really seeing the slowdown. How concerning is that?
Yeah, well, it's I would say it is one that is induced, because we know that the administration of President Trump is looking to reduce the size of the government, and so
Yes.
from the DOG we did see some I won't call them layoffs, but reduction in the size of government in terms of its staff. Although we're hearing currently that some of those workers are being asked come back into the system. So there may be some reabsorption into the system. So largely from the government side, that can be generally managed. But what you need to induce really is the private sector for them to take in more workers. But that of the government can be managed. Those people can be asked to return to work. Though we don't expect all of them to be asked to return back to their desk.
Yeah, and the tech sector, most of them have actually cited the advancement of AI as one of the reasons why they are actually cutting some of these jobs. And the US GDP is projected to grow at about 1.8 in 2026. The projection for full year 2025 is 1.9. So what upside catalyst do you think can help propel the GDP beyond where it is now? We're going to see AI continue to drive productivity within the economy. Could you see any potential catalyst that would help to propel the GDP beyond the 1.8 levels that is being expected for 2026?
Yeah. So we've seen increased investments in AI-related companies and projects. And that has, while we are seeing the growth in investments, it has the double-edged sword of affecting the unemployment rate. So the investments would help to push GDP growth, even if it has a negative impact, a net negative impact on the employment market. So that will help to prop the economy. But I think the basic is really on industrial productivity, and
yes,
given the current position between the US and China, we are seeing China benefit from increased economics of scale. They are like the manufacturing unit of the globe currently. I think the US needs to take back some of its manufacturing, and we see this administration really pushing for that. Some of its manufacturing, so that we can also see growth from that space, and not just on the AI related side, because we've seen increased investments in the AI space, but we are yet to really see the productivity
it translates into like job
come out of that.
numbers
It
and all that.
translates exactly into economic growth. We even some investors and market watchers are already saying that we may have seen assets hit bubble levels, for AI related companies, because of the large investments that have gone in, and we are yet to see the benefits of those investment translate in the general economy.
Yeah, that's true, because we saw the repricing of most of the tech stocks sometimes in October as a result of that. So I think it's try to say that we've seen some revaluation in that space. So as we knock off this discussion about the FOMC and the US market, I wanted to ask what transmission channels, like maybe capital flows, risk appetite, the dollar strength, which of these matter most for emerging markets like Nigeria, looking to benefit from as Fed continues to, or FOMC continues to cut rates? Which of these transmission channels do you think matters most to emerging markets in the months ahead?
So Nigeria, like other frontier and emerging markets, is positioning itself to benefit from FPIs and increased risk appetite, the search for higher yields, from the US and European markets. So we've kept our benchmark rates at high levels. The almost space even attracts higher rates, and it's restricted to FPIs and also and the bank. So the emerging and frontier markets are continuing to position themselves to benefit from the drop in rates in the US market. So we are expecting increased capital flows, and then the search for higher yields to attract FPIs into the Nigerian market. So increasing it, the drop in rates will continue to favor emerging markets, and then the search for higher yields will bring them into markets that are positioning to get those investments.
Yeah, and I'm beginning to imagine that the MPC is actually reading all of this, and that's why they decided to keep rates unchanged. Last week there was OMO auction, that's the open market option auction, where they sold about 1.3 trillion for the 215 and 180-day bonds. This week as well, we expect there will be a bond auction for the 5 and 7 year instruments. Investors are expecting the stop rates to be between 17 and 17.5%. So that's really what we are looking forward to in the fixed income space this coming week. Andrew, what should we look out for on the equities market this week?
So we saw a consolidation last week. We did see particular stocks, the likes in the telecom space, a few banks, and also in the industrial goods space pull some weight, pushing the market to the return of 1.63%. So we expect that consolidation to continue. We are typically we should be in the Santa Claus rally season, but concerns around the capital gains tax and its implementation has doused investors' expectation. But we are seeing positioning ahead of full year and dividend announcements for Q1 for 2025 that will come in Q1 2026. So I expect the consolidation and positioning to continue ahead of the expectations for Q1 2026.
All right, thank you, Andrew. I really appreciate your insightful analysis as always. Thank you everyone for watching and for following us today. It's been a pleasure bringing this to you. We'll really appreciate your continued support. Please like this video, share, comment, and share with your community, right? If you have any questions, please leave those questions for us in the comment section, and we'll be back to provide response to them next week. So thank you, everyone, and bye.
Yeah. Thanks, Doc.